FD is a very simple asset class. The complex asset class are stocks, mutual funds, crypto, and some other things. But I think my objective of this call is to just take them through few things about FDs that were new to me despite doing FD investment for the last 30 years. And answer some of the questions that people might have. And honestly, why this is very close to my heart is um, I've seen my parents saving all of their life and hard-earned money into FDs to realize that few quarters back, one of the banks that they have been investing went bust, and that created so much panic between all of us that how can a bank go bust, right? And then what happens to your FDs? And that's where I started doing a lot of work on FDs, and what stable money also does is to solve some of those things and make FD investment very clear and simple to the investors. And to begin with, I want to give some top level numbers to people, right? In terms of FDs, we talk about FDs की FDs में investment अभी कम हो रहे हैं. People are moving towards stocks and mutual fund. And you'll be surprised to see some of these numbers which are published by RBI. That in India, there are 240 million FDs which are there. So by far, it's the highest invested asset class in India. Out of that 240 million FDs that are invested, average ticket size of that FD is around 2.3 lakhs, which is significantly higher than what we see per stock or the mutual fund investments in India. And of these 233 million FDs that are there are around 50 million FDs which are getting created every year. So, har saal lagbhag, there are 5 crore new FDs which are created in India right now and still growing at a good 7 to 10% year on year rate. So, by no means FD is an old product. FD is still very, very popular across the Indians. But now talking about some of the myths that a lot of us, despite seeing us individually doing FD investments or our parents doing FD investments, and we were not very sure how it works, right? And some of the things are very, very basics, and I'll talk about that. But some things are very, very complex, and it's important that everybody who is doing FD investments or who see their parents or cousins doing FD investment, I think they should definitely know and talk about it. And one basic example of that is interest rates. And I'll tell you how the interest rates on FDs work. So FDs are being offered by banks and NBFCs, right? And in banks, if somebody is telling you the bank FD rate is a 9.01%, what do you think you will earn if you are investing 100 rupees? Generally, you feel that if I'm investing 100 rupees after a year, I'll make 109 because that's the interest rate that is being offered. But that's not true. The FD interest rates is compounded quarterly. So every bank in India, by rule, has to compound the interest rate quarterly. So if any bank is giving you 9.01% interest rate, that's the interest rate for a 3 month. That's the interest rate for a quarter. So after every quarter, that much amount will be reinvested. And for that principal plus the reinvested investment amount, you will start earning over the next quarter. So, for example, a 9.01% FD, which is being offered by Surya Bank right now, gives you a 9.34% annualized return. So, when you are comparing FD returns with any other instrument, it's important to know that the quarterly compounding has to be attributed, and we should look at the annualized return of that product versus mutual funds or stocks, right? So that's one very important thing that most of us never realize that how the interest rate is calculated. The second thing that I think we all have to understand is so far we have been trained that when you have to open an FD in any particular bank, you have to create a savings account, right? But that's not true. And as you can see, recently multiple banks have come up with an option where you can open a FD account with a particular bank. And as soon as that FD is matured or you prematurely withdraw that FD, that accounts get closed. So you don't have to maintain multiple savings account across multiple banks because you have done your investment across different banks to either do the diversification or to ensure that you get the DICGC insurance. So that's also one important thing that you should definitely see when you are looking for your FDs. That now, if you have to go for a higher interest rate FD, but your accounts are in some of the top banks, you will afraid that you'll have to go and create a savings account and you'll have to maintain that, and while tax filing you'll have to get all those details again. I don't think that is required. You can directly open a FD account with that bank without opening a savings account. So that's the second important thing. Now the third most important piece is the insurance piece, right, that I started with. So there is this organization called DICGC. So DICGC is a wholly owned subsidiary of RBI, which manages the insurance across all the banks. So across, there are some 2000, approximately 2000 banks in India, right from the cooperative banks to the top private banks to the public banks, which all comes under this DICGC purview. And all the FDs and the investment happen in these banks are insured by DICGC. Now, there is some complexity around this DICGC insurance, right? How does it work? So first is, with every FD that is getting created, a bank has to go and pay the insurance premium to DICGC. So you have to ensure that the bank that you are investing in are paying that premium to the DICGC. And you will see all of this information available right from whether the FDs that you are investing in, whether that particular bank is DICGC insured or not. So you can go to their website and get all these details very easily. So that's the first thing. Second thing is, up to 5 lakh rupees is insured per bank, but that is per bank per PAN, and that is across all the accounts. So if you have a savings account in a bank, if you have a current account in a bank, and if you have an FD account in a bank, all these three clubbed together should be less than 5 lakh for it to fall under the insurance. Or if some of these three is, let's say, 7 lakhs, and if for any reasons that bank goes bust, you will get only 5 lakh and not the 7 lakh. So that's the most important thing, that people generally think that, oh, my savings account has a different insurance, current account has a different insurance, and FD account has a different insurance. That's not true. And let's say if you have only FD and the balance and current and saving account is almost zero. Another most important thing that you should consider is, people go and invest 5 lakh, assuming that, hey, 5 lakh is insured, so my entire amount will be insured. But 5 lakh is principal plus interest that is insured. So let's say after a year, your 5 lakh becomes 550 and something happens to the bank, you will still get 5 lakh. So it's not like whatever interest that you have earned on a principal comes to you automatically. So that's why I think it's also important that you invest the right amount, so that even if the entire interest is earned, that principal plus interest amount is less than 5 lakh rupees for you to get the complete benefit of DICGC. So let's say, for example, there is a bank which offers 8.75, 8.8% on stable money, or 9.01% on stable money. We recommend our customers that this is a 5-year FD, which is giving you a 9.01% for the retail investors and not senior citizen only. They should invest only 3,20,000 around, so that in 5 years, this amount goes to 5 lakhs and you will get the complete amount if anything happens to the bank. So that's the second thing that you should consider. A third thing that I've seen is people have more than 5 lakh rupees invested in a particular bank, and still their entire amount is insured. So there are different ways in which you can insure more than 5 lakh rupees if you are keeping all of your money in the same bank. And one interesting way of doing that is creating multiple accounts with the bank, right? So for example, if let's say, for example, me and my colleague Nilesh is on the call, so I'll take this example. I'll invest 5 lakh with Saurabh Jain in Bank X. Then Nilesh will invest 5 lakh in Bank X. And then Saurabh and Nilesh can open a joint account where the primary holder is Saurabh Jain, secondary holder is Nilesh. That's another 5 lakh rupees that is insured. And let's say we create the fourth account in which Nilesh is the primary holder and Saurabh Jain is the secondary holder. That's additional 5 lakh rupees that is insured. And there are multiple ways you can add third account holder also in this. And you can create such permutation and combination to make sure that your amount is higher, your insured amount is higher than 5 lakh rupees. The same logic and the formula are mentioned on the DICGC website as well. So let's say for your parents or anybody who has invested in any bank, then I'm sure over this period of time they have saved more than 5 lakh rupees. And if they have all of their FDs in one particular account or one particular FD, I would sincerely request all of you to go back and check that. And please guide them to create it in multiple accounts so that if anything happens to the bank, their entire amount is safe. So that's the most important point that I wanted to convey today about the insurance piece. And you will find all of these details on the DICGC website. You will find all of these details on a stable money app. And at any point in time, if you have any more questions, obviously we'll try and answer it today. But if you have any more questions later on, you can drop us a note and we'll try and answer that as well. So that's the third point after interest rates and savings account, the DICGC part. But the fourth complex piece that I wanted to answer here is about premature withdrawals. And I'll tell you like how it has a very significant impact from the older days. Like so far, if you go out and we did this survey with a lot of our customers and asked them, let's say if you withdraw your FD prematurely, what is the amount that you will get? And 40% of the investors who are also FD invested for a long period of time thought that if anytime you prematurely withdraw your FD, you will get only the principal amount. You don't get the interest amount. That's not true. So what generally has happened is over the past days where our parents used to go to the bank branches to break the FD, they have been told always that don't break the FD because paisa katega and you will not get the full amount. And that has trickled down to all of us saying that if I prematurely withdraw FD, first there is a social problem that I have some emergency and for which I'm breaking, so things are not well with me. And second is I'll get only principal. No, that's not true. So FD premature withdrawal calculation is little complex, and I'll tell you one example. Let's say if you book a 12-month FD, and the interest rate for that 12-month FD is, I'll take one example on our platform, right? So Shivalik Bank, which offers 8.75% for a 12-month FD. And let's say if you withdraw after 6 months, first people think you will get only principal. That's not true. But then what do others think? Others think that if I have taken for 8.75, I'll get half of that in 6 months. So that's also not true. Because bank generally has two components to consider. First is your duration for which you are keeping the FD. And let's say you are keeping it for 6 months. What bank will do is the day on which you have booked the FD, on that day, what was the interest rate for a 6-month FD? Let's say that interest rate was a 4%. They will first consider that and pay you for a 4%. And second is they add a penalty charge for a premature withdrawals. And a penalty charge varies by bank to bank. There are certain banks which don't charge penalty charges. For example, Utkarsh Bank on Stable Money platform, if you prematurely withdraw, there are no penalty charges. But Shivalik Bank or other banks charge 1% to 1.5%. So let's say you have booked a 12-month FD at 8.75 and withdraw after 6 months. You will first be given an interest rate of 4%. Then you will be penalized for prematurely withdraw. Let's say that is 1%. So eventually, after 6 months, if you withdraw, you will earn only 3% interest rate. But you will still earn some interest rate on that. So that calculation is very, very important. And if you see a lot of time on your net banking portals or go and search for any FD withdrawal calculation, it's not mentioned anywhere, right? Because nobody wants to talk about it. First, it's very complex, and banks specifically don't want to tell you that how much you own. So That's very important piece, that when you prematurely withdraw, you should know how the calculation works. Because I'll tell you, a lot of time what happens is you have invested in an FD, let's say at a 6% or a 7%. And after 2, 3 months, repo rate goes up. And after that, the same bank is offering a 8% interest rate, which is 1.5 to 2% higher than what you had invested. It might make sense for you to break that FD and reinvest the FD in the same bank with a higher interest rate where you will make more money. And all of these calculations are important for you to do, and no banks will do that. So that's also one calculator we have on a stable money app where you can come and see that. But that's the fourth part. I wanted to make it clear that how the withdrawal things work. Now, and this one question that I keep getting, because on stable money we have FDs ranging from a 9.25% to 8.5%. And people often ask me saying that, how can banks offer such a high FDs? So first is, I think we all know that banks operate where they take deposits from a savings account, current account, and FD, and give it as a loan to some other customers. And whatever is the margins that they earn is their profit, right? For certain banks, because of the type of loans that they offer and the type of customers that they offer it to, they offer loans at a significantly higher interest rate. So there are small finance banks which offer loans at a 16 to 18%. For such banks, it makes sense for them to get the deposits at 8 and 9%. And these are all banks DICGC insured. So let's say if somebody is offering you a 9%, and let's say some bank, like a big public bank, is offering a 6%, up to 5 lakh rupees, it doesn't matter which bank FD are you creating, because it's all insured in both the banks, right? So, and then it makes all the more sense to go for a higher interest rate FDs. And some of those FDs are available without opening a savings account on our platform as well. But there are different ways in which I have seen over the last 6 months that top 1% of India do their FD investment very differently. Let's say, for example, if I was told 6 months back that there is a bank which offers 9.01% FD and you have 10 lakh rupees, how will you invest? First, I would say I will invest the entire 10 lakh in 9.01. That's wrong, because you should keep a 5 lakh rupees insurance mark. So I'll say that, okay, 9.01%, I'll invest 4 lakh something because I want principal plus interest rate to be 5 lakh. And then I'll invest remaining amount in second bank, which is slightly lower interest rate, but to ensure that my interest rates are there. But what generally the top wealthy people in India do is they do FD laddering. And that's a very new concept to me as well. And why people do FD laddering. So before I tell you why they do, let me just tell you what is FD laddering. So FD laddering is investing your amount across 3 different tenures. And what I mean by tenure is, let's say you book a 1 year FD, 2 year FD, and 3 year FD. So these are 3 different tenures. So that is what people do. So if they have, let's say 3 lakh, rather than putting the entire 3 lakh in a highest interest rate FD, they put 1 lakh in a 1 year FD, 1 lakh in a 2 year FD, and 1 lakh in a 3 year FD. That is called laddering. And sometimes these 3 FDs could be in different banks. That's the smarter way to do, because different banks have different interest rates for different tenures. For example, Utkarsh Bank on stable money has highest interest rate for 2 years, versus the Shivalik Bank has a highest interest rate for 1 year, versus the Suryoday Bank has a highest interest rate for 5 years. And a lot of people on our platform book it across these 3 different tenures in these 3 different banks and do their laddering. But what is the benefit of laddering? The first benefit of laddering is obviously insurance, because if you are breaking it into 3 different banks, you will have insurance across all different banks. Second is, you'll be able to maximize the returns across your FD, because the same bank will have only one highest interest rate tenure. So all the other tenures that you will get will be lower tenures. So, like for example, Shivalik, Utkarsh, and Suryoday example, a customer is able to get the maximum return across all of these 3. The third important thing is a reinvestment risk. And what I mean by reinvestment risk is, let's say if you have um, Sorry, there was some disturbance. So I'll just continue on this. So if you put all your FDs in a 3-year FD, all your amount in a 3-year FD, what will happen? After 3 years, your FD will get matured, you'll get the amount. Now, let's say you don't want to use that money, you want to reinvest that money. That's what most of us do with FDs, right? You will reinvest that FD after 3 years. What happens if the interest rate on that particular day or that particular time is on the low? You will put your entire 3 lakh rupees in a lower interest rate FD. And that's called as a reinvestment risk. That whenever you will do a reinvestment, you might not get a good interest rate. So what people do is they do FD laddering. So let's say I have 1 lakh, 2 lakh, 1 year, 2 year, 3 year FDs. What will happen is every year my FD is getting some or the other FD is getting matured. So after 1 year, my first FD will get matured. Whatever is the interest rate at that period, I'll reinvest. After second year, my second FD will get matured. So I'll reinvest again. So every year, you are getting an opportunity to reinvest your FD investment amount. And there are chances that in sometimes you might FD interest rates will be low and you reinvest it in lower FD rates. But in sometimes you might get a higher FD interest rate. That after 2 years, if the FD rate at its peak, but you have locked in your entire FD at a 3 year, you lose that opportunity to reinvest on that. So that also creates a liquidity for you and solves for the reinvestment risk. So that's also a very interesting technique that generally never been told to us or taught to us, but people who have wealth advisors has been always advised to them. So I genuinely request all of you that you look at your FD investments and see if you can do the ladder on your FD investment. And right now on Stable Money, you have a highest 1 year, highest 2 year, and highest 5 year FDs. That's also one place where you can do that. So that's about FD laddering. I think another point, which is the most important point, and the last point that I'll try and cover before getting on to questions, is taxation. And that's the most important part, right? That a lot of people say that I'm at a 10, 20, 30% taxation. And after FD ka 6-7% and after taxation, I don't even beat inflation. And that's true, and that's a very valid point as well. And that's where we are saying that we should try and make a 9% FD, which is safe, secure, and whatever is your tax slab, the entire interest will be your whatever is the tax slab will be charged on the interest. So there is no leeway on that. The second part is there is a tax saving FD that's also there. But tax saving FDs have different features. So every bank has a tax saving FD which is for 5 years. So you will have to lock in your FD for 5 years, which you can't prematurely withdraw. Plus some of the features that we generally get on FDs, which is FDOD, overdraft of FD, right? Some of these features are also not available on tax saving FDs. So there is a tax saving FD across all the banks, and that's always for 5 years. So that's also one way. If you know that I'm getting 8 to 9% on tax saving, which is generally a very good interest rate, and you don't want that money for 5 years, you can lock in with that particular bank. And that entire amount comes under ATC, that 1.5 lakh rupees benefit that all of us get. So you get rebate on that. Second is there is a concept of TDS on FD, and I'll tell you how that works. Is every year you get an interest on your FD, and that gets, as I've told you, right, that gets reinvested. Let's say if your FD is for 2 years and 3 years. How banks do is if your interest in that particular year in a particular bank exceeds about 40,000 rupees, they will deduct a 10% TDS on that, and the remaining amount they will reinvest. Let's assume that you have done a 6 lakh rupees FD or a 5 lakh rupees FD in a particular bank, and assume that the interest rate that they offer is 10%, hypothetically. So what you will do is you will earn a 10.3, 10.4 kind of a return, because it's obviously quarterly compounding. And you will make more than 40,000 rupees, around 50 to 53,000 rupees on that. They will deduct a 10% TDS on that, and remaining amount they'll reinvest for your next year 10. And this TDS can be claimed when you are doing the tax saving. So very good technique that people also follow is that they ensure that their FD interest rate in that particular year doesn't cross 40,000, so that they don't pay for the TDS. And if you don't pay for the TDS, you actually get a better compounding, right? So that's also one thing that all of us should consider. So these are the some of the important topics that I wanted to mention. But I think above all of this, I think the one most important part that we have seen as a kid as well when our parents used to do, right? There is a very important need, especially in the current market scenario where the markets are going up and down, where jobs are not guaranteed, where the increments are not happening. We always have to have our own emergency fund, right? And there are different ways and the formulas that people and influencers talk about, saying that, okay, you should have a 6 month expense as an emergency fund, you should have a 3 month expense. There is no right answer uh, to that. But I think we should create our own emergency fund where, for me personally, I keep 6 to 9 months of my expense as an emergency fund. And the key important things about that emergency fund is it has to be 100% liquid, so that whenever you want it, you can break it. And it's not like there is the money will come after 10 days or 20 days or whatever, right? The process is manual. You have to go and withdraw that money from somewhere. Second is it has to be risk free. Let's say, for example, I put all of that emergency fund in a stock or a mutual fund, and I need that money today. But today, as you have seen, the markets have fallen by 1%, right? So I'm losing money, but I need that, so I'll have to break that. And my money that I have invested is not giving me any returns or actually giving me negative returns whenever. So what's the point of having that emergency fund? So keep that in risk-free instrument. It has to be liquid. It has to beat inflation. And when you think of these three things, I think there are the two major parts that it comes to. You should have your money in savings account, plus you should have money in FD, which are higher interest rate, RBI insured, which is risk free, and you can break at any point in time. And for us, a lot of people who are not able to calculate what should be their emergency fund, because there is so much complexity in terms of their expenses and family size and insurance and all of that. On Stable Money, we have a very nice section of emergency fund where you can go and tell your basic detail about which city you live in, what is your monthly expense, whether you stay with your parents or family, do you have kids, do you have insurance, and we'll tell you what should be your emergency fund, and also work along with you to create that emergency fund for you. So please do that. So I think these are the key points that I had. I'm so sorry. I realized that while talking to you that I should have used a deck or a PPT to explain some of these things. But don't worry, we'll make one and send it to all of you. But yeah, you have the recordings. We'll share the recordings with you, and we have some time, so we can take some couple of questions from the people. And honestly, I'm not the expert on FD, but I'll try and answer as many questions as I can. But if I can't answer anything, please allow me some time to get back to you on this. So hey, Aisha, I'm done from my side, and we can open the floor for any
Yeah,
questions.
right. If you have any questions, everyone, please drop them in the chat box regarding any. Okay, I'll just take out the question you probably may answer. Which is the best FD scheme according to you, if you have any suggestions?
See, I think there is no best FD scheme, but there is a smart FD. So when you think of smart FD, invest anything which is less than 5 lakh rupees, and don't think about the bank because it's insured. So go for a highest interest rate FD with less than 5 lakh rupees. And currently there is a 9.01% offered by Suryoday Bank on our platform, and that can go down at any point in time. So if you have some cash, please you can go to Stable Money and do that. But yeah, I think the smartest is less than 5 lakh rupees in any bank is a smart FD.
I think he was asking about long term or short term as well. If you had any inputs on that.
Oh, okay. So, see, this is my personal thing, how I'm doing. So don't take it as advice. But we know that our repo rates are at its peak right now, and the repo rates will fall. And when the repo rates will fall, your FD interest rates will go back to 6 and 7. So smart way to do that is you lock in for a higher interest rate for a higher tenure. Let's say 9.01% on Suryodaya is for a 5 year. So let's say after 1 year, the FD rates will fall, even for Suryodaya it will fall. But you have locked in a 9.01% for a 5 year. So where everybody else is earning 6-7%, your FD will be earning 9%. So that's to lock in for 2 to 3 years beyond for a higher interest rate.
Yeah. Is there any FD on MIS? Not sure.
Sorry, I don't know. Yeah, what is MIS? Sorry, some of the terms I don't know.
Sachin, if you can help us with that, that'll be useful again.
Yes.
Monthly income.
So yes. So there are every bank or different banks have monthly and quarterly payouts as well. So you can choose an FD where every month, whatever is the interest comes to your account, or every quarter it comes to your account. So you can choose at what frequency you want the money. And for a lot of senior citizens and parents like us, I think you will need that. So yeah, please. So there is a monthly income scheme on FD that is available.
Okay. Would credit cards with good available limits be a reliable source of emergency fund? You may get 30 to 45 days window to arrange money.
Yeah. So obviously, credit card is a good source of doing that. But the biggest problem on emergency fund is not that you have money or not. It's knowing what is the emergency. And a lot of time I have seen people making a mistake that anything which is not an emergency, we consider as emergency and spend it using credit card. And I've seen a lot of my friends or family members got into that trap that they now have a very long cycle of payouts and the long credit card bills, which they always justify themselves as a emergency. But that's truly not an emergency. But when you are breaking your FD, that's when you will do that really when it is an emergency. So please use credit card. I know all of us who are on the call are very smart in identifying what is an emergency or not. So please use this wisely. Ideal is to create a fund for you. And if the spend goes above that, or you know that this emergency are very short-lived, it's for only 6-7 days, and I'll have the money and I'll repay, then please go ahead and use the credit card.
Why we don't have to worry about the performance of a bank? Why worry to distribute around different banks?
You don't have to worry about the performance of a bank. You don't have to worry about the performance of the bank, but the only thing is, first is you do distribution to maximize your returns, and you also do distribution to have an insurance. And I'll tell you this example, right? And it doesn't look very obvious from outside. Is that the bank that I've seen 35 years in my life, standing next to our house, suddenly goes bust, where the entire savings is there, right? And we never in our life imagined that this would happen to us, but it happened. So please distribute it across different banks because this is eventually hard-earned money. And over a very long period of time, it doesn't matter whether you are earning slightly higher or lower. Safety is the most important thing. So I would really recommend that we distribute it across different banks. The only caveat here, I think, and Balaji is absolutely right, is that it creates a lot of hassle. So be smart in doing this. You do it on a platform where it's easily accessible to you. You don't have to go to the bank. You don't have to open a savings account. And that's what we are seeing, where I think we have right now around 500 crores worth of FD booked on our platform. And all of people are people like Balaji who don't want to have that hassle of opening multiple things, but they want convenience as well.
What's your opinion for keeping the money in a savings account and getting interest on a savings account for emergency funds?
Yeah. So I'll tell you, savings account you should definitely have, and that savings account should be a small percentage of your emergency fund. But you should not keep all of your money in savings account, because in savings account, you're earning 2.5%. right? Though different banks are saying 7% earning on savings account, please go and read those terms and conditions, because you will get 7% when your balance is about 10 lakhs. And for most of us, the balance is not about 10 lakhs. So you will not be earning 7% interest rate on the savings account. So generally, we earn 2.5 to 3% interest rate on our savings account, where even if you prematurely withdraw FD, you will earn around 4 to 5% on that. So I would definitely urge people to have some money in savings account, because that's the most liquid amount. You can just immediately use it. But don't keep all of your money in savings account. Distribute it between FDs and savings.
I think we have an interesting question. Breaking an FD or loan against one, what would you suggest?
I would suggest that it depends on the need. If you feel, like I've said, the need is very short term, please take loan against FD, because it's not only that you are only charged 1% higher loan. It's always that urge in your head that, okay, I have taken a loan, I have to go and close it very quickly. So you'll go and close it. But you know that you need that FD for a long term, and you don't know when you can pay this off. That's the time you should go and break your FD. One very smart way of doing that, and I have a couple of customers on Stable Money who have created some 5,000 rupees ka 40 FDs on our platform. So whenever they have an emergency, they don't break the entire FD of 2 lakh. They'll break 5,000 ka 3 FDs and just use that money. So that the rest of the 1.85 lakh is still earning the interest rate. So yeah, that's how I think I would try and do that.
Is there any RD where I can invest regularly?
Every bank has an RD option where you can do that, but also be sure about RDs, because RDs generally give you slightly lower interest rate because the tenure is fixed. Let's say for 1 year, and if you invest in third month, you will get only for 9-month interest rate. So RDs generally give you slightly lower interest rate.